The digital ticker tape flickered red, casting a tense glow over the heart of Wall Street. Then, in a heartbeat, it flashed green, only to plunge back to red again, mirroring the uncertainty rippling through the market. The closing bell had barely faded when breaking news hit. Tesla's quarterly earnings were out, and the numbers sent shockwaves through the market. Revenue missed expectations, falling short of what analysts had hoped for, but profit margins held firmer than feared, suggesting the company was still finding ways to protect its bottom line, even in turbulent times. The stock swung wildly in after-hours trading as analysts scrambled to interpret the results, their screens lighting up with urgent messages in shifting numbers. Was this a sign of weakness or hidden strength? The debate reignited instantly, with experts split down the middle. Tesla's identity, car company or tech juggernaut, remained unresolved, fueling speculation about its future direction and potential. Every data point, every executive comment was scrutinized with rare intensity. Investors and analysts pored over spreadsheets, searching for clues in the fine print. Investors leaned in, waiting for Elon Musk's words to either calm or inflame the market. His reputation for bold statements meant every sentence could move billions. The real drama was in the interpretation, dividing even the smartest minds in finance. Some saw opportunity, others saw risk. High-frequency trading bots triggered sharp price moves, amplifying the volatility as algorithms reacted in milliseconds. Meanwhile, long-term investors searched for clarity in production and delivery numbers, hoping to see a path forward amid the noise. The report offered surprises, robust cash flow that reassured some, hinting at underlying financial strength, but slowing vehicle delivery growth raised fresh concerns about demand and competition in the electric vehicle market. The stage was set for a fierce debate, pitting optimistic believers against skeptical critics, each armed with their own data and convictions. Tonight was another chapter in the ongoing Tesla saga, a story that continues to captivate and divide the financial world. The battle for the narrative had only just begun, and as the night wore on, everyone knew that tomorrow would bring even more questions, and perhaps a few answers. Let's break down what Tesla actually reported. Revenue came in below Wall Street's forecast, raising immediate concerns about demand. Is competition finally catching up? Are fewer people buying Teslas? The revenue miss suggested a possible plateau, fueling bearish arguments. But Tesla's automotive gross margins were better than feared, a key point for the bulls. The company's aggressive price cuts didn't erode profits as much as expected. Strong free cash flow was another highlight, showing Tesla's core business remains healthy. This financial strength gives Tesla the firepower to fund ambitious projects without relying on debt. The market's reaction? Confusion. The stock dropped, rallied, then settled into uncertainty. Both bulls and bears found ammunition in the numbers. Bears declared the growth party over. Bulls insisted the foundation was stronger than ever. The earnings report didn't settle the argument, it only made it louder. The split reaction mirrored the wider Wall Street debate. Tesla's story remains as complex and divisive as ever. One of Tesla's biggest U.S. challenges on the horizon is the gradual phasing out of federal EV tax credits, a move that could have far-reaching consequences for the company and the entire electric vehicle market. For years, these government incentives have played a crucial role in making Teslas more affordable for everyday Americans, helping to drive strong sales and accelerate the adoption of electric vehicles across the country. But now, with new rules coming into effect, some Tesla models may lose eligibility for these credits, creating what analysts are calling a potential demand cliff, a sudden drop in consumer interest. Without the tax credit, the price of a new Tesla could jump by thousands of dollars overnight, turning what was once an attractive deal into a financial stretch, or even a deal breaker for many potential buyers. We've already seen a similar scenario unfold in Germany, where the abrupt end of EV subsidies led to a dramatic plunge in electric vehicle sales almost immediately. In response, automakers, including Tesla, were forced to scramble, rolling out aggressive discounts and special offers in an attempt to fill the gap left by the lost incentives. Wall Street bears are now pointing to Germany as a cautionary tale, warning that the U.S. market could face a similar fate if government support is withdrawn too quickly. Critics argue that Tesla's impressive sales growth in recent years has been heavily propped up by these government incentives, raising questions about the company's ability to sustain momentum without them. Now, Tesla faces a tough strategic choice. Should it cut prices to maintain sales volume, or hold prices steady and risk a significant drop in demand. Either decision puts pressure on the company's profit margins or its growth trajectory, making it a high-stakes balancing act. Tesla's rapid expansion model, which relies on strong U.S. sales to fund new factories and innovation, could be at risk if demand falters. This dilemma strikes at the very heart of Tesla's growth narrative and its vision for the future of transportation. The stakes for the company and its stock price are enormous, with investors closely watching every move. The end of federal subsidies could fundamentally reshape Tesla's future in its most important market, forcing the company to adapt quickly or risk losing its competitive edge. The Tesla debate is personified by two voices, Dan Ives and Ross Gerber. Dan Ives, a Tesla bull, sees the company as a tech leader with a massive head start in batteries and software. He believes demand isn't the issue, production is, and views every dip as a buying opportunity. For Ives, Tesla's global expansion and innovation are unstoppable. Ross Gerber, once a Tesla champion, now voices caution. He worries about execution, rising competition, and Elon Musk's divided focus. Gerber argues Tesla needs stable leadership and warns that Musk's distractions and controversies create real risks. The bull sees unstoppable growth. The bear sees mounting challenges. Their clash captures the heart of Wall Street's Tesla divide. A key part of Tesla's future is the promise of a truly affordable electric car, the so-called $25,000 Model 2. This vehicle isn't just another addition to Tesla's lineup. It represents a bold step toward making electric vehicles accessible to millions more people around the world. For years, Tesla has been known for its premium models, but the Model 2 could change the game entirely. If Tesla can deliver on this promise, it could double or even triple its annual sales, taking on bestsellers like the Toyota Corolla and Honda Civic. These compact cars have dominated city streets for decades, and breaking into this market would be a monumental achievement for Tesla. Unlocking the mass market is crucial to Tesla's mission and long-term growth. It's not just about selling more cars, it's about accelerating the world's transition to sustainable energy by making electric vehicles truly mainstream. Supporters believe Tesla's relentless focus on manufacturing innovations, like advanced automation and new battery technologies, will make this ambitious goal possible. They point to Tesla's history of overcoming challenges and disrupting the auto industry. But skeptics question whether Tesla can really build a high-quality, low-cost car without sacrificing profit margins or damaging its premium brand image. The challenge is immense, and the risks are real. Legacy automakers dominate this segment with ruthless efficiency, leveraging decades of experience and massive scale to keep costs low and quality high. Critics also worry that chasing a low-margin vehicle could distract Tesla from refining its current models and cutting-edge technology, potentially slowing innovation in areas like self-driving and battery development. The affordable car is a massive gamble. Success could secure Tesla's dominance in the global auto market, but failure could drain valuable resources and focus, putting the company's future at risk. The stakes are high, and execution will be everything. Every detail, from design to delivery, will be under intense scrutiny from both fans and critics. The move could redefine Tesla's identity as a company or expose its limits in a fiercely competitive industry. The world is watching closely to see if Tesla can pull it off, with investors, competitors, and customers all waiting for the next big move. The outcome will shape not just Tesla's future, but potentially the entire automotive industry for years to come. No topic divides Tesla bulls and bears more than full self-driving. Bulls see FSD as the key to transforming Tesla into a software and AI powerhouse. The dream millions of Teslas as autonomous robotaxis, generating income for owners and unlocking a trillion-dollar market. If Tesla cracks autonomy, every car becomes a node in a global network. Bulls argue Wall Street undervalues this potential. Bears, however, point to missed deadlines and the current system's limitations. Critics doubt Tesla's camera-only approach can achieve true autonomy, especially as rivals like Waymo use more advanced sensors. Regulatory and safety hurdles loom large. The robotaxi vision is bold, but remains unproven. For now, FSD is a promise, not a reality. The debate over autonomy is central to Tesla's valuation and its future. Elon Musk's leadership is both Tesla's greatest asset and its biggest risk. His vision has driven Tesla's rise, but his controversial style and divided attention worry critics. The voided multi-billion-dollar pay package raised questions about corporate governance and board independence. Musk's focus is split among several companies, fueling concerns that Tesla needs a dedicated full-time CEO. Supporters argue Musk's boldness is essential for innovation. Critics warn that his unpredictability and public controversies could damage Tesla's brand. The company's future may hinge on whether Musk's strengths outweigh his risks. For investors, it's a high-stakes bet on visionary leadership versus stability. While Tesla's cars grab headlines, Musk is betting big on robotics and AI, especially the Optimus humanoid robot, the vision robots that handle dangerous or repetitive tasks, first in Tesla's factories, then beyond. Bulls see Optimus as leveraging Tesla's AI and battery tech, opening up massive new markets. If successful, it could revolutionize industries and justify Tesla's lofty valuation. Skeptics argue building a useful humanoid robot is a monumental challenge, with little commercial success so far. Critics fear Optimus is a costly distraction from Tesla's core business. The project embodies Tesla's high-risk, high-reward approach. Optimus could be a game-changer, or a cautionary tale. Why is Wall Street so divided on Tesla? Because it's not just a car company, it's a battleground of competing narratives. Bears see slowing growth, fierce competition, and a risky CEO. Bulls see a tech leader poised to disrupt trillion-dollar markets. Every earnings report and Musk tweet fuels volatility. The debate isn't just about numbers, it's about Tesla's very identity. Is it a car maker or an AI powerhouse? Visionary-led or risk-laden? The answers will determine who wins Wall Street's wildest debate. For investors, the key is asking, can Tesla keep growing, innovate as promised, and execute at scale? The stakes couldn't be higher.